Alana and Jack, can you hear me?
Yep, I can hear you.
Oh, I can hear you so clearly. That's wonderful. What about you, Jack?
Yeah, I can hear you.
All right, great. So we're going to get started. I don't. It's a shame that other people don't come, but I looked at some of the homework. Not homework. I looked at some of the graded work that you're responsible for. So I decided let's go over that. So could you make sure you have a notebook or a recorder? If you have a tape recorder. Actually, I am recording this, so you will get the audio. So maybe you don't have to do that, but things happen. So what I'm going to do is I'm going to talk about um, assets to start off with. Let's see, where is it? Assets. Of course I don't see it. Okay, there it is. All right. Now, let me see. Can you actually see me, or you just see what I have up on the screen? Can you actually see me?
I
People,
see
you can
both.
see.
You see a little box of me? So here's what I wrote down. Can you read that, or is that too difficult?
I can read it.
Good.
Yeah.
So it's assets. There's different assets we have. We have liquid assets, we have investments, we have real property, and we have personal property. So jewelry would be an example of personal property. And our house, which is real estate, would be example of real property. A liquid asset would be cash, the money in our purse or in our pockets. And investments would be like for instance, stocks or bonds. So let's take a look at this. This is you will come across this in Cengage. Is anybody, just before we get started, and by the way, welcome everybody. It's nice to see both of you. I hope more people will come. Did you have any trouble getting from Canvas into the Cengage assignments? Because I'm getting a lot of emails that people are having difficulty.
No.
I didn't.
All right, you guys are just brilliant. That's what's going on. Okay, so the balance sheet. Does anybody? Well, there's an accounting equation which is the balance sheet. The equation is assets equal liabilities plus owner's equity. That is the foundation of accounting. Assets equal liabilities plus owner's equity. What does that mean? Here you have a bucket of assets, and we talked about liquid assets, investments, real property, personal property, and you have money you owe, like the mortgage on your home. So the liabilities is the portion of your assets that the creditors have a hold on. And your equity is everything else, is the difference between what you owe and your assets. That's your equity. That's what you're worth. So let's take a look. Preparing a personal balance sheet or statement of financial position. Sometimes when you go to the bank and you want to take out a loan or maybe even a mortgage, they will ask you for something like this, or you'll fill out their form. And it has three parts, as we said: the assets, liabilities, and net worth. Let me just make sure there's three of us. I want to make sure nobody else's needs to be admitted um, to the room. So these three parts, when taken together, is a picture. It's a financial picture. Think of a snapshot. If I was to take a picture of Alana and Jack right now, it wouldn't look the same if I took a picture next week. You'd be wearing a different outfit. Maybe your hair would be combed differently. So this balance sheet is basically a financial picture at some point in time. And your net worth, as I told you, it's down here in bold. Net worth equals your total assets less total liabilities. What you're worth, your net worth, is what you own less what you owe, O-W-E. That's what it basically, because I'm sure you've heard the term, yeah, my net worth. I'm sure sometimes at these parties you hear people talking on and on. So let's take a look. Here's something you will see. You'll get this chart and you'll be asked to select what kind of property, what kind of asset are diamond earrings. So what do you think, Alana? I should have left the answers out, but what are diamond earrings? It's jewelry, right? Alana, you have to unmute yourself.
Personal property?
Yeah, good. And a pension, that's an investment because it's going to be drawn upon later on. Like I worked for a college in New York for 11 years. Now I'm getting a pension. So that was an investment. I had to pay into it during the 11 years I worked at the college, and I'm glad I did because now I'm able to collect this monthly amount from my pension so it could subsidize my Social Security. Because Social Security, unfortunately, is not enough money to live uh, well. I mean, you could do it, but it would be difficult. Now, stock is another investment. Jack, what about the land that your home sits on? In your case, maybe your parents' home. The land that your parents' home sits on. What
It's
is
going to
that?
be real property.
Yeah, good. Very good. Very good. And sometimes you'll have a fence around your property. Anybody ever see that beautiful white fence, that PVC fence? It's very costly, thousands of dollars. Once you put that on the land, it really becomes part of the land. Because if you removed it, it would kind of damage the land. So even the fence becomes part of the real property. So what about the fence around your property, Jack? What is that?
Is it going to be real property too?
Yeah, good guess. Good guess. All right. I have a friend with me today. I don't know. Can you really see me in a box? I can't. I can't tell because I don't know how to do this. Oh, okay. All right. So he just wants to say hello.
Huh?
He's just saying a quick hello. All right. I got to keep you guys awake. So your leg and myself.
Huh.
Your Lexus automobile. What is that? What do you think that is?
Would it
Real.
be personal property?
Yes, it is. It's personal property. Very good. Alana, you want to take a mutual fund within the year?
Liquid asset?
Yes, very good. Because a liquid asset is you can turn this asset into cash within a year. That's what makes it liquid. Let me just hang up the phone. I should disconnect all the phones before I get on. So cash is also another liquid asset. So assets are items you own. Without regard to how an asset is purchased, each asset is placed into one of the following categories. And here's the definition that your book gives you. Liquid assets are low-risk financial assets, low risk, held in the form of cash or investments that can be readily converted into cash with little or no loss in value. Investments are assets acquired to earn a return rather than provide a service, such as stocks, bonds, mutual funds. And also, real property, as you brought up, Jack, is immovable property such as land, anything fixed to it, like a fence, and the house.
Yeah.
Property has relatively long life and high cost. It may appreciate in value, which means to increase, and then you'll be benefiting with this investment ultimately. Personal property is movable property like your auto, your recreational equipment, your household furnishings, your collectibles, and example, as they said, the Lexus automobile. So if I wanted to know the net worth of myself and I knew my assets were 125,000 and I owed on my mortgage 85,000, what would my net worth be in that example? Let me see if I can in
Um,
the chat box. So I have assets of 125,000 and I owe, meaning liabilities, I owe 85,000. What is my net worth?
$3?
40,000, right? Or
Yeah, yeah. Alana, were you going to say that?
Yep, yeah.
Good job. You were right. Okay, so that you're going to come across this problem in Cengage, and now you'll be able to ace it. So now let's go and do a new share. I want to make sure I'm recording. I always forget to start recording. Okay. So let me do a new share. I'm getting good at this. In the beginning, I was like, what do I do next? Okay. So here's another one. let's talk about the future value of money. So now you have a very generous grandmother, and she gives you $6,875 for your 21st birthday. But there's one condition. She wants you to put it away for 6 years before you can touch it. So, and she helps you, she introduces you to her financial person, and you do what she says, because you love your grandmother. And this time value of money is a concept that means that your dollar today will be worth more in the future because it earns interest. It earns a rate of interest over a given period of time. So Grandma knew how to invest this money at 7%. I'd like to know where she found that, because it's about 3% if you're lucky today. And I put away my money for 7 years. When I lost my house to Hurricane Sandy, I took that money from the house and put it into a 7-year investment, and I think it was more like 2.5% now. 7% would be fabulous.
Couldn't you do it through like different companies?
Sure, you can, like they say, diversify. Yes, you can. You can invest in what they call an annuity, or you can open up a Roth IRA. I would talk to my banker, and you know what? It doesn't hurt to have a conversation. You don't have to do anything. You just hear what he has to say, and then you could store it away for when you're ready to make that step. So let me see. I want to just arrow down. I'm always having trouble navigating here. Where is my arrow down? Okay, let me see if I could do page down. Let me try that. Page down. Nope, not working. So here we have the present value. The money that Grandma gave you today was $6,875, $6,875. She wants you to put it away for 6 years. That's 6 periods. 6 periods. And then the rate of interest is 7%. So these are the 3 criteria in order to determine what they call the future value factor. So now I'm having trouble making this thing go down. So let me make it smaller so that we could see the whole thing, only because I don't know how to scroll down. Okay, is that too small for your eyes?
No.
Oh, wonderful. So here we go. This is how you look at a future value chart. How many periods did we say, Jack?
What's that?
How many periods or years did we say?
Was it 7 or?
It's up here.
Yeah, it's still kind of blurry. It's
Oh,
8 or 6
no,
or
it's 6. Okay, let me make it a little bit bigger. Is that better?
6. There it is.
Okay. So you got to go down to 6, and you got to go over to the appropriate percentage. What was that, Alana?
7?
Yeah. So what's this number? 1.501. Could you take that number in your calculator or on your phone, 1.501, and times it by what Grandma gave you, and tell me what you get? What do you get?
$10,319.30.
And 38 cents. Good job. Yes, that's the answer. See it here? So when that money, the money my grandma gave you, and you're making it sit for 6 years at 7%, when you go to take it out, you'll have made almost, well, actually, close to $4,000, I think. Maybe 3,500. I can't, let me look at the math, okay. So 10319.68 was what Lilana said, minus 6,875. So you earned $3,444.68 in 6 years. That's pretty good, right? For doing nothing. Doing nothing. So this is the future value of a single amount. There's another thing called an annuity, but right now we're just dealing with one number. One number. So let's take a look now at my next slide. By the way, does anybody have any questions whatsoever?
No.
No questions? Any questions on navigating or questions on anything? You're welcome to, talk. We'll talk about it. Because that's why I'm doing these meetings, to kind of clarify so you could do your work. This is a strictly online class, so you don't have to come to these meetings, but if you can, it's not a bad idea. It can only help you. So here's the importance of keeping good records. I personally like QuickBooks. because it's easy and it's good to have that. And sometimes I have to answer questions. Well, you know, I'm retired, so sometimes I have to fill out forms, and all I have to do is go to my QuickBooks and create reports based on all the information I put in all the time, and it's so helpful. Somebody will ask me a question, I'll be like, I'll get back to you, and bingo, it's right at my fingertips. I don't have to go looking for papers or compiling things. I have all these numbers at my fingertips, so it really helps. And also, when I'm sorry to bring this up, for some reason I've been thinking about it lately because it's getting close to October. That's when the hurricane hit in New York in October of 2012. Because I was pretty good at keeping my records together, I had to fill out so many forms after the house got destroyed, and that helped a lot because I was able to get a lot of different things and apply for different grants only because I had good records. So you'd be surprised how important this is to be keeping track of what you have and what you owe. It really made a difference. All right, so good record keeping is important discipline. Yeah, because it's work. It's not fun. I mean, I happen to think it's fun because I like accounting, but you might think it's work. So you map out your financial goals. And sometimes I'll take a look at last year and say, what did I spend my money on? And then I'll say, wow, I spent an awful lot of money on eating out. I think this year I'm going to not eat out as much. And then I'll say to myself, I'll eat out once a month. You know, you can't make these decisions until you actually have something to look at and base your decision on. Also, if you get an IRS audit, just imagine how easy it is when you have all your paperwork together. So that's very important. So according to this, you should do record keeping, prepare a financial statement at least once a month, they say. Well, to tell you the truth, if you have QuickBooks and you put the information in, of course you have to make sure you put it to the right account. You know, if you're spending cash, you want to credit cash and debit whatever you bought with the cash. You can't, garbage in is garbage out. But once you do that in QuickBooks, QuickBooks puts together a report for you in the blink of an eye. So you just have to put the information correctly into QuickBooks. QuickBooks does all that for you. It's a great program. Also, there's something called Quicken. Never liked Quicken. I felt it was too simplistic, but you might like it. Ideally, keeping a ledger will help you summarize all your transactions. So a ledger is a big book, and it has each asset, liability, or equity that you have. So the one page will say cash, and it'll have all the ins and outs of your cash. One page will have inventory. One page might have jewelry. Another page will have maybe accounts payable that you owe to different vendors or that you bought stuff, or mortgage payable. Liabilities usually have the word payable in it. They have it in their name, so it's easy to spot a liability because it has that payable part of its name. And then let's see. Okay, it says here, I said a month, but down here it says it's recommended you prepare them at least once a year. So it's actually once a year, not once a month. So let's change that. It's not once a month. They're recommending once a year. Once a year. Imagine all the things you may purchase throughout the year. A printer. I bought a printer last year. A new set of windows for your family room. Can you picture sitting down and trying to remember what you did? But by keeping this ledger, you can keep track of all the stuff you did. And then you'll be able to have a look at what's in the ledger. I mean, first of all, I teach online, not only at the college, but I also teach children on my computer. So I have to keep track of all these things that I buy for the purposes of teaching the children, like all my little dolls, because children like to be entertained and they learn better that way. I actually like to be entertained as well, so it's not just young children. So keeping good records is a very important step in the financial planning. And you should have a bank account, you should have credit card numbers, the location of deeds, titles, like on your car, or title on your mobile home, birth certificates, death certificates, and you should have this all in a safe place, preferably fireproof. I actually bought a little safe and I put it in my room. Most of the time it's not locked, but I just like the idea that it's fireproof. You should make sure that a trusted family member or an attorney knows the location of this list. Additionally, you will want to keep separate records of important purchases on the home and keep a file for tax-related documents. Information such as purchase price of assets is necessary because when you go to sell an asset like a home, you want to find out what was the gain or loss on the sale of the home. Now, I'm getting close to, I'm in the last phase of my life, so this is a very important thing for me to do to get all my, as they say, ducks in a row. And but it doesn't hurt to get in the habit of doing this because then you will always be organized with your books and records. It's worth the work. It really is. Anyone have any questions about keeping organized? Is that?
No.
Oh, that's good. That's good. So we did keeping good records, the future value of money, the balance sheet. We have one more to go. And then I'll entertain any questions you have. But now when you go to do your assignment, you'll have at least seen this once, and it won't be unfamiliar to you. So understanding income and expense statement. So if you have income, let's say if you have a business and you have income and you subtract the expenses, the result of that equation is income. If the revenue is smaller than the expenses, then it's going to be a loss. So preparing an income and expense statement for a personally, where does all my money go? Where does all my money go? This statement takes income and it subtracts the expenses to determine what the family's cash surplus is. Now, we did that budget. Do you remember the budget? Did both of you do the budget? I think you did. I think I remember grading it. That was what we did. We did a little bit of a income and expense, but it was a budget. It wasn't actual expenditures, but they were estimated. But nevertheless, that's the format. Income was on the top, and we subtracted the pertinent expenses that we estimated. But in this case, we're actually figuring out what they are. And again, QuickBooks will prepare that statement for you. You just click on Reports, Financial, Profit and Loss, bingo, there it is up on the screen, 1, 2, 3. The income expense equation is designed to determine if a cash surplus or deficit exists. Taking total income and subtracting the expenses results in net cash value. So if the cash value is positive, this indicates that the individual or family has a cash surplus. In essence, the income exceeds expenses. And that's a good thing. That's what you want. Because if it's the other way around, where it's negative, that indicates that the family has a deficit. So what will they do? Then they're going to use the credit card to buy groceries because they don't have enough in the checking account. Then they're going to use the credit card, for different things. Maybe they're going to borrow money. So they have to look at their budget and see what can we cut out of these expenses to cut down on this deficit, or do I have to get a second job? Do I have to get a second job? So they have to look at these things and see what the solution is. It's always better to try to cut down on the expenses because it's no fun working 2 jobs. I've done it, and it's no fun. So if you can cut down on expenses, it's better. So let's see. So property taxes, is that a cash coming into my family or paying property taxes? Is that a cash out, Alana and Jack?
Cash out.
Yeah, that's a cash out. Very good. So now cost of business meals. Maybe I take my clients out. Sometimes if I have a boss, he's going to pay for me. He's going to reimburse me. But maybe I have my own business and I'm taking clients out to dinner so I can discuss business. Is that a cash in or a cash out, Alana and Jack?
Cash out.
Good job. So now I'm a realtor and I sell mobile homes because right now I'm trying to sell my mobile home. So that's kind of like on my mind right now, and I'm having a hard time. And it's so beautiful that I'm crying that I have to sell it. It's so gorgeous. But anyway, if the realtor who sells it for me, let's hope he does. I don't know, he's kind of dragging his feet. I don't know why he's dragging his feet. He hasn't shown it to one person in 6 months. I think that's That's terrible, but that's just me. I'm not happy. So I went and I painted the inside of the whole place. I mean, I tiled the bathroom. I made it even more beautiful than it was already. So, and meantime, this guy hasn't shown it to one person yet. So I'm hoping that this is going to be the month. So the sales commission he gets, let's hope to goodness that he's going to sell my place. He's going to get a nice hefty sales commission. So is that cash coming into this realtor, or is it cash going out for this realtor?
Is it cash in?
Yeah, that's income. That's revenue for him. That's how he makes his money. He makes a commission on what I get. And he gets a pretty hefty commission, in my opinion. And I don't really feel he's earned it, but that's my sour grapes, and I promise I'll be good for the rest of the conversation here. Can't help it. You have to do your research. You know what? I didn't do my research on this guy. I should have done some better research and found out what did he actually sell, and I didn't do that. I just got mesmerized by the postcard he put in my mailbox, and he looked like it was him and his wife. I got bamboozled, and I didn't do research on him. So always do research if you can. He's not a bad guy. He's just not doing what I expected he would do. He's not a bad person. Income or cash in includes common sources of income such as wages. So if you work a part-time job, you get wages, or salaries, or self-employment income when you have your own business, or bonuses, or commissions, or grandma gives you gifts. In addition, interest earned, dividends paid, proceeds from the sale of an auto or my mobile home. That money will be proceeds from my mobile home as an income. And also pensions, annuities, Social Security, alimony and child support, scholarship and grants, and tax refunds. So these are all examples of income. Examples of cash out or expenses are four major groups. They say living expenses. And if you're living with mom and dad, this is what they're paying for you. Because a lot of people who were doing the budget, they said, I don't make any money and I don't pay for anything. Well, yeah, you don't pay for anything, but you cost something. You have living expenses, even if it's not coming out of your pocket. I mean, you're not, you've got to be clothed. You have to eat. You need medical attention. You need to get from point A to point B. You need lights and telephone, meaning your cell phone, and you need a roof over your head so you don't get rained on. So that's living expenses. And then tax payments, you might have to pay the IRS. You have to pay the IRS, and it comes out of your paycheck as withholding taxes. And then when you file your return, sometimes you paid too much and Uncle Sam gives you some money back, and then that's income. Okay? Sometimes it happens. Or sometimes they give you a stimulus check. Your family might have got a stimulus check. So asset purchases is also money going out. You buy an auto. You buy furniture. You have a loan. You take a loan out on these purchases. And let's see. And then finally, there's also these miscellaneous personal care, like my shampoo, special shampoo for red hair, and recreation. I like to sing. I like to go to karaoke, but I haven't gone in 6 months. I miss it so much. I do love to sing. I don't know why, but I do. And then entertainment. I love watching movies. So I have to control myself. I will order a DVD from Amazon. I mean, I could stream it. I like streaming the movies, but sometimes I like to sit in the kitchen and put it. I have my TV set up with the DVD. Sometimes I just want to put the DVD in and watch it, because then I can pause it or whatever. So I've got a bunch of stuff going on, but I know how to stream. I like Netflix and all that. So I love my movies. I don't know why, but I do. Okay. And so does my dog, Toby. Toby loves movies also. So let's look at this table. So we have fixed expenses because the amount is set by a contract. Like when you have a mortgage, you're told you have to pay $3,000 a year for that mortgage, $3,000 a month for that mortgage. Part of it is real estate tax, part of it is interest, and part of it is paying down the principal on the cost of the home. So there's three things in that mortgage payment. Also a plumbing bill. That's unexpected. It comes up and you didn't even know it was going to happen. Or a grocery bill. You go out and buy food. You don't know what you're going to spend. You don't know what you're going to buy. You just go in there. So a plumbing bill would be a variable. It depends. Fixed that's going to be set by a contract. All right, so the capital gains tax, that's set by the government, the IRS. There's certain rates, so that's fixed. But the plumbing bill, the cost of repairing my car, that's all, what's the word I'm looking for? That's all variable. So that's it for today. That's all I'm going to talk about today. Is there any questions before I, say goodbye to you good people?
No, I'm good.
No, I'm good too.
I'm so happy that you came. I'm